Hi, thanks so much for joining in. You're watching the Mutual Fund Show on NDTV Profit, and my name is Alex Matthew. This show gets you insight on everything mutual fund related. What should you buy? What should you sell? What should you hold in your portfolio? All of that and more. On today's episode, we're focusing on quite a popular equity mutual fund category, and that is the Flexi Cap category. In case you're unfamiliar with how this category works, it is what gives the fund manager a blank slate to work with, while several other schemes have restrictions in terms of market capitalization allocation towards or how they construct their portfolio. For example, like the large cap actively managed schemes have 80% minimum towards the large cap category. Multi-caps have minimum of 25% to each of large cap, mid cap and small cap, and 25% for whatever the fund manager chooses. The Flexi Cap category allows the fund manager to choose whichever stock they want in whatever allocation they see is fit. Now, we're talking about this because we want to talk about one of the outperformers over the last several years. In fact, let's pull up the top performing schemes, and the data that we have has to do with the degree of outperformance over the benchmark that they have. And you see right on the top of this list is JM Flexi Cap Fund, which has, along with Quant Flexi Cap Fund, outperformed its peers to a very large extent. Now, this show also gets you the insight from fund managers, and I like to call them onto the program to try and get you to understand how they're looking at asset allocation, how they're looking at building their portfolios, what policies they follow when they're constructing their portfolio. And to that end, my guest today is Satish Ramanathan, who's the CIO of Equity of JM Flexi Cap Fund. Thanks so much, Satish, for taking the time, and pleasure speaking with you. Could you take us through what you're seeing in the equity markets right now? Because a lot of your peers, a lot of the market watchers right now are saying that valuations are stretched and that it is difficult for a stock picker to find value. Not impossible, but difficult.
Good afternoon, Alex. Thanks for having me on the show. Yes, to an extent, the valuations have become higher than what they were last year and the year before that, for that matter. But we also have to understand that corporate India has deleveraged. Corporate India is a changed animal considerably, with net profits of 14.4 lakh crores and a higher cash flow than what this number would suggest. So the potential growth that is possible for corporate India is significantly higher than what we could see 2 years back. And we see corporate India as in the large cap companies, the mid cap companies, and small cap companies having paid down debt considerably and are looking for the next leg of growth, which would come through in the next 2 to 3 years. So we have a strong balance sheet and a visibility of growth, which lends to this optimism.
Okay. We'll delve a little deeper into the portfolio construct in just a bit, but just to set the context for that, could you take us through the philosophy that you follow when you're selecting the stocks that make up your portfolio?
Yes, thanks for asking this question, because we get this asked by a lot of our investors. So what we do is we actually follow the diamond strategy, where we look at the top-down macro, we look at what is driving growth, which sectors have tailwinds for consistent growth, and we map it with the companies that are able to execute flawlessly. So they should have a strong balance sheet, committed management, and an ability to execute the strategy required in a fiscally prudent way, so that we are able to get the best of both worlds. And we call this the geek strategy. The diamond-shaped strategy of top-down and bottom-up mutates into the geek strategy, which is growth in earnings with earnings quality. And as we keep filtering the companies, we are dynamic across sectors, across cap curves, because we know that growth cannot be restricted to only one sector for a long period of time. It turns around and we see pockets of undervaluation in some other sector. So we trim the performing sectors to some extent, or book profits, and move to the next sector. So it is this dynamic approach in our FlexiCap fund, which is a true to label FlexiCap fund, that has helped us outperform in recent times.
That's interesting because, I'm looking at your June end fact sheet, and that points to 40% allocation towards large cap, around 19% towards mid cap, and 39% towards small cap. And that broadly looks at the kind of allocation towards market capitalizations. Can you talk about how this has shifted, if at all, over the last 3 years or so?
Yes, in January 2020, we had a large cap allocation of 93%. And as we were doing our bottom-up research, we understood that large caps were not the only companies that had turned around, but there was significant turnaround in mid caps and small caps. And that helped us take a step gingerly towards mid caps. And towards September of last year, we started cutting down mid caps and increasing small caps. So this is how our allocation has worked, because we found that mid caps were a little more expensive relative to growth as compared to small caps. And that's how the philosophy has evolved over time.
And that continues to be the case, Satish? Or would you see, for example, and we're in July of 2024, you've just spoken about the reasons why, or to a certain extent, certain reasons why the valuations to some extent are justified. The potential for growth is there in several companies. Deleveraging has taken place. Will this portfolio dynamic in terms of allocation towards market capitalizations, will that shift meaningfully, or do you think that it will more or less be the same?
So in the case of large caps, what we find is large caps would be growth will be limited. And the only way they can grow is to buy new businesses at a cheaper price than what they currently trade at. So we call it the Goliaths of India. And the way they can grow is to buy into growth. Whereas the smaller companies, which are in newer sectors, we see that as a long-term growth opportunity, and they can continue to grow in their space unhindered.
Okay. I see that, and correct me if I'm wrong, around only 2% of cash as a percentage of assets under management. Is this something that will more or less always be the case? Will you ever use cash? Will you ever hold cash, or will you always deploy?
We in general deploy cash across sectors, across opportunities and timelines. We do not use cash as a tool to kind of de-risk or de-lever the portfolio in any way, because cash is meant to be deployed into the best available opportunity at that point in time. And that's what our philosophy towards cash is.
I want to talk about sector allocation, and I see the top 3 holdings are all banks, large banks at that, and your allocation towards financial services is your single largest allocation at 22% odd. Of course, others have more because you are quite diversified, as you pointed out, across sectors. But could you explain to me why you're so bullish on financial services?
No, I think to some extent the pool of profits in financial services is the largest. While they are not growing necessarily as fast as we expected them to, the valuations have also become more reasonable. In financial services, we have distinctly divided our financial services into 2 buckets. The first bucket is consumer-facing financials, and the second bucket is infrastructure financing. And this is how we have actually demarcated the financial services basket exposure. And we believe infrastructure funding is going to be the next long-term growth opportunity. And therefore, we have a mix of both in our allocation.
Interesting. Talk to me about what you believe is going to be the major growth area in your portfolio based on the allocations that you've made, the thesis behind the current portfolio selection.
So the thesis behind the current portfolio selection is it will be growth as usual. We expect cap goods and infrastructure to do reasonably well. Valuations are stretched, so on a tactical basis, we may increase exposure to defensives from time to time. But having said that, we are optimistic that the growth in infrastructure will continue to deliver superior returns.
Satish, I'm not asking you to project what will happen. Practically nobody can do that. I haven't met someone who can do that yet. But having said that, over the last 3 years, you've been a significant outperformer. And the outperformance, the degree of outperformance, particularly over the last year, is startling to say the very least. One, would you say that some part of that is because of easy maneuverability? Do you think that getting significant inflows from this point and building your asset base very significantly will limit the nimbleness that you have so far been able to achieve? And two, do you think that caution is warranted from the perspective of the investor, at least in terms of setting expectations?
As regards point two, definitely yes, because the valuations are richer than before. So the growth momentum in stock prices need not map necessarily the kind of earnings momentum that we have seen in the past. So we will see a bit of a disconnect there coming in from time to time. One. As regards the earlier question, in terms of our size becoming a handicap, right now the size that we have is very comfortable in maneuvering the portfolio, as you rightly indicated. But we do not think that it is going to actually deter us if we become bigger in terms of moving the portfolio. I think a lot of churn is required in a dynamic market, and what our philosophy and our process throws up is what we follow rather than necessarily saying that it's a buy and hold strategy. We reassess ourselves, our portfolio, vis-a-vis the actual dynamics that are taking place in the market and the industry, and then we allocate accordingly.
Okay. Last question, Satish, and not necessarily a tough one because I think you've already had conversations about this. What, according to you, is the key risk, both for your portfolio as well as for the Indian equity markets in this year?
I think the key risk is, of course, the US elections and the outcomes of US elections and what it does to trade, etc. But that apart, I think the Indian economy has matured considerably. The sizes of the companies have grown tremendously. There is a higher degree of stability of these companies' cash flows and the discipline that we see across managements in being capital efficient, in being focused on the financial performance and ensuring that they do not take undue risks is what gives us confidence that there will be pullbacks, but the pullbacks will not be as severe.
Fair point. Satish, pleasure having you on the program, and thanks so much for taking the time.
Thanks, Alex. It's been a pleasure talking with you.
All right, it's time to slip into a very quick break. We'll talk about the flexi cap category as a whole and some of JM Financial flexi cap's peers, and to help you understand how you should make a selection. And we'll also take some of your queries. So do stay tuned.